You're in your 40s, 50s, maybe even 60s, and wondering, what should I do with my savings, retirement bonuses, or accumulated assets to secure a safe and comfortable retirement? This question isn't yours alone. Millions of middle-aged Americans, after years of hard work and careful saving, find themselves struggling when it comes time to reinvest. They want safety, but they don't want their idle money to lose value to inflation. They want growth, but fear taking on too much risk. The truth is, not having a proper reinvestment strategy can slowly erode your wealth, a silent threat no one wants to face during the golden years of their life. So, what's the right path forward? Today, we'll explore 5 smart reinvestment strategies trusted by millions of Americans that not only help preserve your capital, but also grow it effectively. These approaches are especially well suited for those in the 40 to 60 age group. 1. Reinvesting in dividend ETFs. For many people, financial planning undergoes a crucial shift. The goal evolves from aggressive accumulation to the strategic preservation of wealth and the creation of a sustainable income stream for retirement. This is the moment to transform decades of hard work and savings into a clear strategy that not only protects your assets, but also generates the steady cash flow needed for a future of freedom and peace of mind. Too often, fear or inertia causes people to leave their capital in low-interest savings accounts, where its value is slowly eroded by inflation. A smarter approach involves putting that money to work without taking on excessive risk. One of the most effective and accessible strategies for this life stage is investing in dividend exchange-traded funds, ETFs. A dividend ETF is a single investment that holds a diversified portfolio of stocks from established companies with a proven history of paying and growing their dividends. By investing in a fund like the Schwab U.S. Dividend Equity, SCHD, or the Vanguard Dividend Appreciation, VIG, you instantly gain ownership in a professionally managed basket of reliable businesses. This method eliminates the guesswork of picking individual stocks and offers a low-cost, transparent, and long-term solution. The primary strength of dividend ETFs lies in their ability to generate a stable, passive income. The dividends paid by the underlying companies are distributed to investors, typically on a quarterly basis. This predictable income can be used to cover living expenses, or for those who don't need the cash immediately, automatically reinvested through a dividend reinvestment plan, DRIP. This process harnesses the power of compounding, allowing your investment to grow exponentially over time. The strategy is designed for stability, freeing you from the stress of daily market tracking and short-term fluctuations. Furthermore, dividend ETFs provide essential risk management through built-in diversification. Relying on a few individual stocks exposes your portfolio to company-specific downturns, where a single negative event can have a devastating impact. An ETF, by holding dozens or even hundreds of companies, spreads this risk. The poor performance of one company is buffered by the stability of the others. This resilience is paramount when your financial priority is protecting capital rather than chasing high-risk speculative gains. This investment vehicle also offers significant flexibility. You can choose to receive the dividend payments as cash to supplement your income for travel, healthcare, or family support. Alternatively, you can let them reinvest automatically to maximize long-term growth. Importantly, this powerful strategy is remarkably accessible. Modern, user-friendly platforms allow anyone to get started in just a few clicks without needing to be a financial expert. At this stage of life, financial decisions demand a strategic mindset. Investing is less about chasing the highest possible return and more about securing the lifestyle you have worked tirelessly to build. Dividend ETFs are not a get-rich-quick scheme. They are a prudent, time-tested solution for achieving financial security with simplicity and efficiency. By putting your money to work, you let time and compounding do the heavy lifting, paving the way for a comfortable and confident retirement.
2. Buying I-bonds and Treasury bonds. As you enter middle age, your financial strategy often shifts from chasing high returns to seeking safety, stability, and the preservation of hard-earned wealth. Especially in a time of economic uncertainty, rising inflation, and unpredictable markets, the need for low-risk investments that still provide steady income becomes more urgent than ever. This is exactly where U.S. government bonds, specifically I-bonds and Treasury bonds, reveal their true value. I-bonds, issued by the U.S. Treasury, are specifically designed to protect against inflation. Their interest rate consists of two parts: a fixed rate, locked in for the life of the bond, and a variable rate that adjusts every 6 months based on the Consumer Price Index, or CPI. This means I-bonds can maintain your purchasing power even during periods of rising prices. Treasury bonds, on the other hand, are long-term government bonds, typically 10 years or more, that offer a fixed annual interest rate. Backed fully by the U.S. government, they are among the safest financial instruments available. With predictable returns and dependable income, Treasury bonds are ideal for those preparing for retirement, where the goal shifts from rapid growth to capital protection and risk control. What both of these bonds have in common is extremely low risk. Unlike stocks or mutual funds, which can swing wildly with the market, U.S. government bonds offer peace of mind with virtually zero risk of default. That's why many financial advisors recommend that once you reach your 50s, you allocate a portion of your portfolio to these bonds to create a personal financial safety zone. Beyond their safety, I-bonds and Treasury bonds also provide stable income. Every year, you'll receive fixed or inflation-adjusted interest payments, offering a reliable source of passive income without needing to monitor the market. Notably, during the inflationary spike of 2022-2023, I-bond rates soared to over 9%, significantly outperforming traditional savings accounts. Another advantage? Tax efficiency. Interest earned from I-bonds is tax-deferred until you cash them in and is exempt from state and local taxes, a major benefit if you live in a high-tax state. In short, if you're in your 40s to 60s and looking for a safe, stable investment that protects your purchasing power, I-bonds and Treasury bonds are essential tools in your financial portfolio. You don't need to track the markets. You don't need to worry about short-term volatility. Yet your money keeps working, quietly and steadily, giving you peace of mind amid economic uncertainty. Don't let inflation silently erode the value of your wealth. Allocate a portion of your assets to government bonds and enjoy the financial confidence you deserve in the final years of your career.
3. Investing in life insurance with a cash value component. As individuals enter their 40s and 50s, a significant shift occurs in their financial perspective. The focus pivots from aggressive wealth accumulation to strategic wealth protection and optimization. The primary question evolves from how much more can I earn to how can I safeguard what I've built and ensure a secure future for my family. In this crucial stage of life, one of the most powerful yet often overlooked strategies is permanent life insurance, specifically policies like whole life and indexed universal life, or IUL. Unlike term insurance, which provides a simple death benefit, these policies are sophisticated, dual-purpose financial instruments. They function as a two-in-one solution, offering both a protective shield for your loved ones against unforeseen tragedies and a robust vehicle for long-term wealth creation. The engine behind this growth is the policy's cash value component, a living benefit
that distinguishes it from traditional insurance. This cash value accumulates over time on a tax-deferred basis. With a whole life policy, it grows at a contractually guaranteed fixed rate, offering stability and predictability. With an IUL policy, the growth is linked to the performance of a market index, like the S&P 500, allowing for greater upside potential. Critically, this accumulated value is accessible. You can borrow against it or make withdrawals to address life's needs without liquidating other investments or incurring immediate tax penalties, providing invaluable financial flexibility. The 40 to 60 age range is the ideal window to implement this strategy. Starting earlier allows the power of compounding to work its magic, maximizing the policy's potential growth. This accessible pool of capital becomes a versatile resource for various life events. It can supplement retirement income, acting as a private tax-advantaged pension. It can cover significant medical or long-term care expenses that health insurance may not fully address. Furthermore, it can be used to fund a child's education or a new business venture without disrupting your primary investment portfolio. One of the most compelling attributes of these policies is their stability in a volatile world. While stock portfolios can fluctuate dramatically and real estate can be illiquid during economic downturns, the cash value in a permanent life insurance policy offers a dependable buffer. IUL policies, in particular, provide a unique advantage. They participate in market gains up to a cap, but are protected by a 0% floor. This means your principal is secure. You benefit from market upswings without risking losses in a decline. Finally, these policies serve as a cornerstone of efficient estate planning. The death benefit is passed directly to your beneficiaries, typically free from income tax. This allows you to create a substantial financial legacy for the next generation, bypassing the complexities and potential tax burdens associated with other assets. In conclusion, permanent life insurance is far more than a mere safety net. It is a dynamic and foundational component of a midlife financial plan. It empowers you to manage risk, preserve capital, and create tax-efficient growth, all within a single, secure vehicle. By integrating this strategy, you take decisive control of your financial future, ensuring both protection for today and prosperity for tomorrow.
4. Reinvest in short-term rentals or REITs. As we move into midlife, traditional real estate investing, like buying and managing a rental property, can start to feel more burdensome than beneficial. Dealing with tenants, maintenance, and legal paperwork takes time, energy, and patience. Fortunately, for those seeking passive income from real estate without the hassle of being a full-time landlord, there are two compelling alternatives: REITs, real estate investment trusts, and short-term rental hosting. REITs allow you to invest indirectly in real estate assets like office buildings, shopping centers, apartment complexes, or warehouses. Instead of buying an entire property, you purchase shares in a trust and receive quarterly dividends generated from the rental income or property sales within the portfolio. Popular REITs in the U.S., such as Vanguard Real Estate ETF, VNQ, or Realty Income, O, have a strong history of delivering consistent and transparent returns. The standout advantage of REITs is simplicity and accessibility. You can start with just a few $100s. No property management, no late-night tenant calls, and no worries about damage or repairs. For older investors, REITs offer a hands-off, professionally managed, and reliable income stream ideal for supplementing retirement. At the same time, if you already own a property, or even just an unused room, short-term rentals through platforms like Airbnb or Vrbo can be a powerful way to generate additional income. Unlike long-term leases, short-term rentals offer more flexibility, higher nightly rates, and full control over when and how the space is used. And thanks to modern tech platforms, managing a short-term rental is easier than ever. From listing to payments to guest communication, everything can be streamlined. You don't have to be a full-time host to run a successful income-generating property. This makes short-term rentals especially attractive for those looking to turn spare time into extra cash in the years leading up to or during retirement. Another key benefit is diversification. With REITs, you can choose to invest in sectors you understand or feel confident about, like residential housing, healthcare facilities, data centers, or logistics warehouses. With short-term rentals, you control the pricing, booking calendar, and guest experience, allowing you to optimize profits while managing risk. In short, whether you prefer the passive route through REITs or want to maximize the value of property you already own through short-term rentals, both approaches offer excellent benefits: steady income, flexibility, and long-term asset preservation. You don't have to be a full-time landlord to earn income from real estate. With today's smart solutions and technology, you can build sustainable passive income while keeping your retirement light, flexible, and financially secure.
5. Invest through Robo-Advisors. Between ages 40 and 60, many people begin to think seriously about retirement. When should I retire? How much is enough? How do I invest without risking what I've worked so hard to build? But not everyone has the time, expertise, or desire to track the market every day. That's where Robo-Advisors, automated investment platforms like Betterment, Wealthfront, or Schwab Intelligent Portfolios, offer a smart, stress-free solution for busy, middle-aged Americans. Unlike traditional investing, which requires you to analyze stocks, follow the news, and make constant decisions, Robo-Advisors are fully automated investment tools. After answering a few questions, your age, income, retirement goals, and risk tolerance, the system builds a personalized portfolio for you. It's diversified across stocks, bonds, and ETFs, and aligned with long-term financial strategies. One of the biggest advantages of Robo-Advisors is their convenience and low cost. With annual fees typically ranging from just 0.25% to 0.35%, you still get access to features like automatic portfolio rebalancing, tax loss harvesting, and intelligent asset allocation, all without paying thousands for a personal financial advisor. More importantly, because these platforms operate based on logic and algorithms, emotions are removed from the equation. That's especially crucial as you approach retirement. Fear of losing money can easily trigger poor decisions, like panic selling during market dips or staying on the sidelines during recoveries. Robo-Advisors stay disciplined and consistent, always working toward your long-term goals. Another major benefit is time savings and peace of mind. You don't need to spend hours reading financial reports or analyzing stock charts. Everything is designed to support your goals with minimal effort. For those still working full-time, managing a household, or simply uninterested in micromanaging investments, Robo-Advisors offer an ideal low-maintenance path to wealth building. Most platforms also include built-in retirement planning tools, cash flow projections, and progress trackers. You'll always know where you stand on your journey toward a secure retirement. You can adjust your goals, increase contributions, or shift risk levels, all with just a few taps on your phone or clicks on your computer. In short, you don't need to be a financial expert to manage your wealth effectively. Robo-Advisors act as your trusted digital financial assistant, helping you build a sustainable, diversified, and cost-effective portfolio that keeps you on track for retirement success. With Robo-Advisors, you're not just investing smarter, you're investing with calm, discipline, and clarity in a way that fits seamlessly into your life. As you enter midlife, preserving and growing your wealth isn't optional, it's essential if you want a future that's free, secure, and independent. What matters most is not how many years you have left until retirement, but what you do with the years you still have. Whether you're in your 40s, 50s, or even approaching 60, it's never too late to adjust your financial strategy. Every smart step you take today moves you closer to a retirement you can actually look forward to. Choose the strategy that fits you best and take action today. And don't forget to subscribe to the channel so you never miss simple, safe, and powerful financial insights, guiding you step by step toward your version of financial freedom in retirement.